So, good morning, everybody. My name's Jeremy Mindell, and I'm doing the series, or one of the CPD series on expanding overseas. This lecture is given on behalf of K3 Hub, CPD training, and I'm giving this lecture on expanding overseas, looking at the tax opportunities and the traps. So very pleased to welcome you all on this sunny Friday morning. There are also the slides are available, as you'll see on the chat box. The other elements to be aware of is that session will what we're looking at with this session is a events one. So what we're looking at here is an opportunity for you to look at all the issues coming from your clients or yourselves from expanding overseas. I see a hand up. Anything in particular? Sorry if it is, please put something in the chat box. Hopefully you can hear me and all is good. So the other element is that the Q&A, yeah, so there is the no slides in the chat. Okay. Sorry, what the slides will be sent to you, I believe, on that basis. So the other element is please feel free to ask questions at any point. You can use the Q&A rather than the chat box for that. If there are any queries in terms of the technology or the contact, then please ask Helen Madden, and she will hopefully help you on that basis. So without any further ado, I'm going to start on this, and there will be, it's due to finish at 12, and there will be 2 breaks somewhere around the 10:30 mark and somewhere around, the 10 o'clock mark and somewhere around the 11 o'clock mark. So what are we looking at here? So introduction. We're going to look at creating a permanent establishment, the rules and the consequences, sending personnel overseas, the tax, social security and controlling staff costs, intercompany pricing, avoiding transfer pricing challenges, registrations in other countries, VAT and other taxes. We're going to look at double tax treaties and how to use them. We're going to look at dealing with international tax challenges posed by tax authorities. And finally, we're going to look at known unknowns. What do you need to know about counterparties overseas even when only acting for the UK entity? A quick reminder of international tax principles. So when I look at international tax principles, one of the important points is that companies and businesses are subject to tax on their profits where their principal activities take place. So if I'm, say, manufacturing bird feeder boxes in the UK and I export them to the Netherlands, generally speaking, I'm taxed on the activity, the economic profits that I make in the UK, because that's where I make the bird feeder boxes. If I just get them shipped to the Netherlands, then I'm not subject to corporate tax in the Netherlands. However, if I open up an office or have a sales activity in the Netherlands, that could create a permanent establishment. And companies and businesses are charged corporate taxes where they are resident or where they have a permanent establishment. So let's say I have a big bird feeder box business and I have some customers in the Netherlands. And at some point I decide that in order to service my customers better, I'm going to set up an office in the Netherlands. At some point, the level of activities would become big enough probably to create a permanent establishment, and therefore I would need to allocate profits to that permanent establishment. Taxes are also imposed via domestic legislation. International treaties do not impose tax where it does not exist in domestic legislation. And that's the important principle. You hear about things like the OECD Pillar 2, the minimum 15% corporation tax rate. I think what is important about that is to understand that that does not become effective in different jurisdictions until it is passed under domestic legislation. If it doesn't get passed under domestic legislation, then it doesn't become effective. And that's one of the important principles that you need to think about it on that basis. And then further, that double tax treaties can be used to eliminate double taxation, but cannot be used to impose a tax charge that does not exist in domestic legislation. In other words, if, for example, what it says is that under the treaty, the withholding, you can withhold 10%, but actually under domestic legislation, there's no withholding tax imposed, then there's no withholding tax imposed. So if domestic legislation doesn't impose a withholding tax, you don't actually have to look at the treaty. That's particularly important in terms of the UK, in terms of dividends, where generally speaking, there is no withholding tax on dividends. Other principles, economic substance takes precedence over legal contracts if the two contradict each other. Again, what is important is the reality of the position. Helen, you've raised your hand. Is there something I'm doing? Can people hear me? Is it okay? Hello? Can people hear me if people want to say in the chat box? Can they hear me and see the slides? Okay, fine. That's fine. I've now got enough on the chat box. That's great. Thank you, everybody. You always worry that you're going to be Sigourney Weaver in space. You know, they say the famous title to Alien, no one can hear when you scream. And you sometimes feel the same thing talking into these machines. Other elements, a permanent establishment may lead to additional corporate taxes being due. So going back to my example in terms of my bird feeder boxes, which are sold in the Netherlands, as I say, if I start establishing a presence in the Netherlands on a permanent basis, I could end up with a permanent establishment and therefore tax in the Netherlands as well. And the final principle that I look at is a company should not be subject to tax on more than 100% of its income. What do I mean by that? If, let's say, I make £100,000 and I split my operations between France and the UK, if the UK taxes £50,000 worth of my profits, the French should not tax more than the other 50,000 of my profits. And if the French want to tax 60,000, then there needs to be discussion between the French and the UK tax authorities about who is taxing what and how much. Okay. So from that, I want to lead on to permanent establishment, because as I talked about, you know, my person who sells bird feeder boxes, I do have a client selling that to the Netherlands. At the moment, he just picks up the bird feeder box. He's sent a truck over to Kent where they are manufactured, and he collects them. So there's no question of a permanent establishment. But what if you expand your operations overseas? What do you need in terms of a potential permanent establishment? What we would look at there is the permanent establishment is the building blocks for corporation tax liabilities, first of all, but also could affect your pay-as-you-earn and social security position, because once you have a place of business in another country, you end up potentially with not only a corporate tax liability, but also potentially a social security liability, as well as tax withholding on tax withholding on wages and salaries. Let's look at this principle a bit more. So the way this works on the taxation of business income is you have an enterprise, and Article 7.1 of the Model Treaty says the source state may only tax if the business activity constitutes a permanent establishment. You then go to Article 5 of the Model Treaty. That is the treaty which most developed countries have based their double tax treaties on, which is the OECD, Organization of Economic Cooperation and Development Model. And you look at typically Article 5, there is the definition of permanent establishment. And if there is a permanent establishment, not only where the enterprise is resident, but also in another state, then you look at Article 7, you go back to Article 7, and you look at the attribution of income. And you go from a situation of looking at, in principle, whether you're trading with or in a country. So in my example of somebody who produces bird feeder boxes and the customer comes and collects them and sells them in the Netherlands, they are trading with the Netherlands, not in the Netherlands. And I use this as another example. This is from a film, very good film with Ryan and Tatum O'Neill called Paper Moon, where they sell rather nefariously Bibles set in Depression America, Bibles literally off the back of the car. And on that basis, they're certainly not creating a permanent establishment, as anyone who's seen the film would look at. I recommend the film. So that's, if you like, a good example of a trading with a another country rather than trading in. And when you look at those elements, you might look at a sales trip. That's definitely trading with. So therefore, no permanent establishment. A conference. I went to speak at a tax conference a week and a half ago in Marrakesh, and that was definitely not trading in. That is trading with. That does not create a permanent establishment. Providing services, it depends on the type of services you have. In terms of warehousing, there is a carve out for that, where you are warehousing and storing your own goods rather than a business of storing other people's goods. But if you have a fixed base or manufacturing, that is trading in a jurisdiction rather than trading with. And therefore, a fixed base manufacturing and some services could create a permanent establishment. What is normally excluded from permanent establishment would be storage and processing, delivery of goods. That has to be your own goods, because if you're doing it for somebody else, that is your main business, and that would not exclude from a permanent establishment. Purchasing of goods. So if I purchase goods, timber from overseas, that is not creating a PE. Collecting information, public relations and R&D, research and development, invoicing, and collecting claims. Now, all of those elements individually would not create a PE. But if you add them together and you have a substantial enough operation, you could create a PE on that basis. Other elements, as I say, the definition of a permanent establishment is found in the Corporation Tax Act 2010, and it's based on Article 5 of the Model OECD Treaty. In the UK, follows the Model OECD Treaty quite carefully and exists where a company is either a fixed place of business in the UK through which the business of the company is wholly or partly carried out, or an agent acting on behalf of the company which has and habitually exercises their authority to do business on behalf of the company. This does not include an agent of independent status acting in the ordinary course of his business. The interesting element is when you look at a permanent establishment, you would look at a place of management, and the first element there, it encompasses a place of management, and that creates a problem because where you've got a place of management, that could be your own home. If I go and set up a sales business in my own home, that could be a place of management. branch, an office, a factory, a workshop, all of those sorts of elements, and a building site or construction or installation project. And all of those potentially create a permanent establishment. As I said, warehouse PE could exclude warehousing, delivery, displays, collecting information and preparation of goods. But as I say, the tax authorities are looking to restrict the carve-outs because they think they have been exploited by certain multinational organizations. Recent developments on that basis have been the base erosion profit shifting program, or the anti-base erosion program, started 9 years ago in 2015, action plan for different actions. BEPS Action 7, additional guidance on the attribution of profits to permanent establishments. And there was an amendment to Article 5, which the UK is thinking about adopting, where you have an independent agent. Are they really independent? If they habitually conclude contracts, this is one of the recent developments, or habitually plays the principal role leading to the conclusion of contracts that are routinely concluded without material modification by the enterprise. In other words, they are rubber stamped by the head office. So if I set up, I don't know, a sales agreement in the UK and a contract, but I don't sign it, I send it to my head office in Ireland to get it signed, that could still indicate that I would create on this basis a permanent establishment in the UK, because although I don't sign the contract on that basis, I don't sign the contract, I am actually doing the principal work towards it, and all the head office is doing is rubber stamping it. Again, substance over form on that basis. I haven't had a single question so far. So are people following it? Does it all sound reasonable? Does anyone have a question? I think it all sounds reasonable. So when I look at permanent establishments, the question is, what is wrong with this? Apart from being somewhat distracted. Thank you, Simon. Um, so what is wrong with this from a PE point of view? Well, apart from the fact that this lady is possibly being distracted by her daughter, the problem with this is that, of course, this could take place anywhere. And it could be that this lady is carrying out the main duties or indeed directing the company. And if she's doing this consistently in another country, that could create a permanent establishment. And the same could be true here. Even if I take my stuff out to the garden, therefore have laptop with spreadsheet and do lots of stuff, potentially I'm either doing main duties, or even worse, I'm managing the company and potentially creating a different residence for the company, which is a whole new kettle of fish, because if you're resident in another country, you could potentially be liable on the full amount of tax revenues in that country if I switch my central management control. Say I decided to lecture permanently in Spain, or even for a period of time. I can't see myself doing that. It's far too hot this time of year. But let's say I decided that all my online lectures were going to be done in Spain. Potentially, I create a threshold beyond which the Spanish tax authorities might decide I need to actually pay tax on my profits. Yes, permanent establishments could be your home address overseas quite easily. So let's say I went to a flat in Spain and I ensconced myself there for a long time, particularly if it's an owner-managed business. So it's not something I've done without the permission of my employer, but something that I've done. I've done. Thank you for the question. Something that I've done as part of my business. I've decided to lecture overseas. Then I would end up potentially with a permanent establishment overseas, or indeed changing the central management control of the company. Yeah, you do get slides of the webinar. Okay, thank you for the question. But it's an important one because one of the big issues is that there has been a huge crackdown in this area. And this is one of the things that people need to think about quite carefully in terms of the scope of their overseas work. And in terms of corporate tax residency, you need to watch for the changes in central management control because of board meeting locations. And you're going to need to think about the sort of questions are, what is the normal residence of the directors? Often look at their nationality, normal place for board meetings. Has there been a change to residence and board meetings? Is this only as a result of an emergency? Where you have virtual board meetings, the risks there are the composition of the board, the number of specific country directors, and decision making that's done at the board. Is it a rubber stamp for decisions made elsewhere or not? The period over which the practice continues, an isolated incident in which directors participate from the UK when set against a history of regular non-UK meetings, and the type and level of decisions being taken by the board during that period. The OECD, this is the point at which I would mention the OECD, the Organization of Economic Cooperation and Development. They, since about the 1960s, have been overseeing the tax system. They do not have formal powers or very few formal powers, but their guidance is much appreciated and looked at in terms of, in particular, developed countries look at their guidance and use that for the management of their double tax treaties, but also in terms of the OECD has played a central role, and I do would stress as a fairly central role in some of the reforms that have happened to international corporate tax in recent years. They distinguish between the usual and ordinary activities of a business and the temporary and exceptional. If you move the ordinary and usual activities to somewhere else, then you will have tax consequences. If it's only a temporary and exceptional movement because of an exceptional circumstance, then a tax authority may overlook it. Now, I did these slides a little while ago, not that long ago, but why Denmark might seem rather apt after yesterday's shambolic performance by England. I couldn't believe it myself. Anyway, Denmark is not only known for quite a strong football following and a quite good football team, well, certainly was good enough for England last night, but actually because of its geographic position as a gateway to Scandinavia and also from continental Europe, and a gateway from from Scandinavia to continental Europe. People are often placing operations in Denmark, and they end up with questions of PE, which the Danish Tax Council answer. Why is it relevant? Well, because Denmark operates on relatively similar rules to the UK. And therefore, if you look at various articles in the Tax Journal, the Danish decisions are reported and are particularly relevant to the UK. A Q&A. Would a non-executive director who's resident overseas create a permanent establishment risk? They aren't involved in managing the business, but attend quarterly board meetings virtually. I would answer probably a single one on that basis. No, wouldn't give you a problem. If you have an executive director, then I think you have more of an issue. This is an interesting one, as I say, P Denmark, Germany. Before COVID-19 struck, the Danish Tax Council was approached by a German company with an employee working from home in Denmark on a 6-month contract. The company sought a binding ruling over whether it created a PE in Denmark. The decision considered some issues relevant to evaluating PE risk and home working and centered around 3 key points which must be present for a PE to exist. a place of business that is fixed. It must be a location where the business activities are carried out. The Danish Tax Council found that the employee's office was not irregular. The employee was building a Danish marketplace for the German company, implying continued activity in Denmark, and the activities performed were core to the German business. The Danish Tax Council concluded that a German company had created a PE in Denmark. Not surprising in my view, but note this was in a home. However, where instead of having an employee in a place, you have a contract with a Danish company and you are not directly supervising the employees, then you may not get a PE. So this is at the end of COVID ruling about whether a German company pays for a sales service company in Denmark, creates a PE in Denmark. The Danish company is responsible for the day-to-day management of the sales consultants. The sales agents do not have an employment relationship with the German company. The sales activities include customer care, market analysis, customer meetings, and participation in trade fairs. The DTB concluded the Danish company should be considered an independent agent, and the sales activities in Denmark would not create a PE for the German company. And the reasoning for this conclusion is, amongst others, that a Danish company has the power and control to organize how and when the sales agents perform the work for the German company, and the sales agents are not subject to any detailed instructions from the German company. The Danish company provides similar services to other companies which are not related to the German company. So if I have a relationship with an independent company and they are truly independent, then I don't create a PE. And Denmark has been quite busy in terms of PE provisions, in terms of new tax treaties, and this is one with France on that basis. And the final one with Denmark, don't really want to go on too long after last night's result, but there you go. 9th of February 2022. This went the other way and a PE was created. Again, a good example, something which you can apply in the UK. Sales activity of a non-resident company would create a PE in Denmark. Swiss company hired an employee to handle certain sales activities focused on car dealers in the Scandi market. The activities performed by the employee included getting new customers, keeping a database of customers, marketing new products, and certain administrative items. The new person was a Danish national. The work he performs is very limited in the Danish market, but is predominantly related to other Nordic countries, and is carried out from the home of the employee since there's no office of the Swiss company in Denmark. The employee spends most of his time traveling and visiting car dealers outside Denmark, and the Danish tax board concluded the Swiss company has a PE in Denmark since the activities performed by the employee are part of the main activities of the Swiss company. The DTB emphasized that the employee would have a central function of the development of the Scandi market, since the employee was employed with a view to establishing sales channels in such market. The employee's geographical location is in Denmark. If the employee would not have been located in Denmark, it would have been more difficult to carry out sales activities in the Scandi market. And this is the point about the gateway, Denmark being a gateway, and the UK is often a gateway from, say, the US to Europe and vice versa. And it applies in a similar way. You can get, I'm not going to go through many more. You can look at the slides in leisure, but the Indian tax authorities took a case, and this was about whether a joint venture created a permanent establishment. And what they said was that the overseas Japanese company did not have a permanent establishment. Indian company was just providing access to the premises, does not constitute a fixed place permanent establishment for a Japanese company. In this case, the employees of the Japanese company did not provide supervision in connection with any building site or construction, installation, or assembly project, and the existence of supervisory PE did not exist. So again, you can look at that on various bases, but as I say, you can look at this in some leisure. My final one overseas, which is quite an interesting one, is where an employee went and stayed abroad during the lockdown, and perhaps unsurprisingly, during the lockdown, was not seen as creating a permanent establishment in Spain. And that was fairly common. But what happened afterwards was, once the lockdown and travel ban were lifted, the employee decided for personal reasons to stay in Spain. The UK company requested the employee to return to the UK, but the employee refused and resigned. Did that create a PE? The employee was present in Spain for more than 183 days and therefore been resident in Spain, but the UK company did not bear any cost connected to the employees working remotely from Spain. The reasoning during COVID was fairly obvious that this was an extraordinary event, and most tax authorities did not pursue companies for creating potential accidental PEs at that point. But what about after the COVID lockdown? Well, the interesting element there was the General Director of Taxes concluded the employee's home office was not at the disposal of the UK company. Secondly, working from Spain was a personal decision and was not imposed or required or indeed authorized by the UK company. The UK company did not bear any costs, and the UK company has an office in the UK which could have been used by the employee to develop his work without the need to be in Spain. And indeed, the employee's wish to remain in Spain led to the breakdown in the relationship. HMRC has also given a few examples, and this is one of them there. One who works for a foreign entity in State D comes to Brighton on holiday and stays on to work for a total of 40 calendar days, including his holiday, using the office of a UK affiliate company as a base. He enjoys the experience so much, he decides to do the same thing 6 months later. HMRC have said that this would not create a PE because, again, this is a personal decision and it's not structured by the company, and it's just tagging on time onto the end of a holiday. Whereas in the Francine case, a French national with an English partner joins a French company on a permanent contract, which permits her to spend fixed 3-month periods each year working in the UK. Well, on that basis, HMRC have zoned in on the fixed 3-month period each year working in the UK, and by contrast, was said that could create a permanent establishment. Here we've got lots of holidays. Alexei, Luca, and Sarah all work for a foreign entity in State C. They come to the UK on holiday for the same part of the year with their families staying at different addresses. They're all permitted to stay on an additional 30 days to work in the UK by their employer, using the office of a UK affiliate company as a base. But because, again, it's just holidays tagged on with no structure to it, doesn't create a PE according to HMRC. Whereas in this case, Company T has a team of staff in its Zurich office. Over the course of 9 months, 6 staff are permitted to spend 6 weeks each in turn at an affiliate company's office in London. The issue which creates a PE is that they're working on a project in London, and that might well create a PE. And the final one, Jasmine, who works for a company based in the UK, is seconded to cover 6 months of maternity leave for a related foreign company in State E. She does this remotely from a UK office and a home in London. Well, I would say that really depends on the nature of the duties she's doing on that basis, and that would be very much, you would need to look further into that case. Question. Overseas employer of record type arrangements have been becoming more popular. Have you seen these lead to overseas PE risk? I'm not sure, James. I've not seen employer of record arrangements. You need to explain a bit more what these involved. I'm not aware of it. If you want to send me an email afterwards, I'll look it up. But I'm not aware of employer of record. It doesn't ring a bell at this particular minute. Obviously, on this basis, it's important to watch for other countries' rulings, the scope of their rulings, the definition of activities which could qualify for a PE, which, although they're often based on Article 5 of the model OECD treaty, do vary from country to country, and also the end of any grace periods which may have been given for emergencies. So, for example, when we're looking at um, COVID, most of the emergency leniencies ended over 2 years ago at the beginning of 2022 or some way through 2022, whereas you may have other emergencies such as the Russia-Ukraine war, which could create other potential leniencies being given. Any questions on that point? So I'm going to move on a bit to domicile very briefly, and look at some of the proposed changes and other regimes in other countries. So when you look at this with domicile, the current arrangement is that potentially people coming to the UK could be outside, or rather their earnings and chargeable gains and assets could be outside income tax, capital gains tax, and inheritance tax for a period of up to 15 years, in terms of where income is earned or chargeable gains are made outside the UK, or they have non-UK citus assets for IHD purposes. Once you get to 7 out of 15 years, you pay a charge of £30,000. And after year 12 to year 15, it becomes £60,000. And on that basis, there is what is called a remittance based charge. And money which is overseas and which is not subject to UK tax cannot be brought into the UK on that basis. The Conservatives under Jeremy Hunt announced changes to the domicile rules, which will become effective 5th of April 2025. With the general election, those rules have not been passed into law and have not been published, but effectively replacing the concept of domicile by a residency test, which means UK domiciles could qualify on this basis if they've been away for 10 years, and also limiting the relief to effectively 4 years with some transitional provisions, and 10 years for IHT. So 4 years potential exclusion of foreign income and chargeable gains, no charge for it, and you can bring those gains into the UK. So the remittance basis would be abolished. This creates a regime which is actually more beneficial for the first 4 years. And indeed, in terms of overseas workday relief, where a proportion of your income could be attributable to overseas earnings on a workday basis. Let's say you work 48 days out of 240 overseas, that is 20% of your time. If you earned £100,000, then 20,000 could be excluded from UK tax. This would work for 3 years, and under the current regime, you're not allowed to bring the 20,000 into the UK. Under the new proposed regime, you could bring the 20,000 into the UK. And then there's some transitional provisions potentially in terms of bringing old money into the UK, which is covered by the remittance basis, and paying at a concessionary rate of 12%. The Labour Party has copied these, or its proposals don't differ very much, except for a couple of important differences. The transitional provisions Labour are not keen on, the 50% relief for 25-26, and potentially more importantly, whereas the Conservatives allow the ability to create excluded property trusts to keep your non-UK citus assets out of UK IHT on a permanent basis, Labour would not allow this. So it'll be interesting to see after the election what happens on these bases. But it's important also to understand that they're both losers and potential winners on this basis. Potentially people have been abroad 10 years, even if they remain domiciled in the UK, could end up finding IHT only on their UK citus assets. And UK citizens who've been abroad a long time and come back to the UK could actually access this benefit. So some way to see. Quite often these domicile proposals do get changed as time goes by. If I look at other regimes, so the French have a regime, if you've been not resident for 5 years, exemption from supplementary employment income for 8 years, or exemption for 30% of employment income. Italy has a very generous regime. You've been not resident for 9 out of the last 10 years, potentially exemption for foreign income and gains, an IHT gift tax exemption for foreign assets, and the time limit for that is 15 years, with a payment of potentially £100,000 in fees. And this type of regime has been attracting a lot of high net worth individuals to places like Milan. And there was an article a couple of weeks ago about the effect on Milan of suddenly all these high net worth individuals coming into the city. Not all beneficial. It has an effect inevitably on property prices and indeed the cost of living. Portugal had a regime for arrivals before the 1st of January 2024, where if you've not been resident for 5 years, exemption for foreign income and gains, except pension income, subject to beneficial 10% rate, and a special 20% rate for Portuguese income from high value activity. Again, a time limit of 10 years, but this is only for arrivals up to the 1st of January 2024. Spain has something nicknamed the Beckham Law, because it was introduced about the time that David Beckham was transferred from Manchester United to Real Madrid. Oh, for somebody as talented as Beckham in our current England team. Eligibility, not resident for 5 years, EU national with employment contract, and digital nomad visa for non-EU citizens. Exemption for foreign income and gains, special 24% rate for the first 600,000 of Spanish income, time limit of 5 years. There's also a lump sum scheme for Switzerland, which has been around for some time in certain cantons where you pay a lump sum and no more, which has been very attractive in cantons such as Zug. And the UAE also, just for completion, given how many expats go to Dubai, also has a very attractive regime. Any questions on those points? So if there are no questions, the chat. Format of an overseas entity. We're looking at a branch versus a subsidiary. So you've gone abroad. Do you create a branch or a subsidiary? And the easiest way of looking at it, this is how I would explain it to a Court of Appeal judge. Believe you me, having been to the Court of Appeal, they take tax cases, complex ones, and they decide, is a garden fork the same as a spade? No, it isn't. And another one about playing bridge and what trumps one element. You'd be quite surprised and maybe slightly disillusioned about the simple way in which tax terms need to be explained by KCs to judges who are not well versed in taxation. Yes, I think we had one about a pool table as well, but I do remember one about garden equipment, and is a fork a spade if I call it a spade, and another one about if you play bridge, does one element trump another, which was reference to orders of legislation. Anyway, format of an overseas entity. In this basis, I would look at a tree. So a branch in a tree is part of a tree. And even if you have a branch, it is part of the main element. And a branch, therefore, is legally part of a main company. The accounts are integral to the main part of the main company. The profits are included, fairly easy to offset losses on that basis. So quite often when you start off, particularly with a loss-making branch, it is something that is quite useful in terms of ease of offsetting losses, particularly in a startup operation abroad. The overseas aspect is that a branch will normally be a permanent establishment. There will be a tax on local activities. There might be branch profits taxes. You may have to look at hybrid rules to see that elements may get two deductions or claim two deductions, in which case there needs to be an adjustment unless that same corresponding income is also included in both jurisdictions. And you may need to look at the local employment laws as well. Under Corporation Tax Act 2009, there's an election potentially to exempt branch profits, covers all branch profits in qualifying territories, normally where they are taxed in the other territory, they're not taxed in the UK. Transition rules for losses carried forward before the election for exemption has been made, and you should consider any treaty relief on that basis. Why use branches? Well, easier to claim loss relief, and you've got simpler accounts on that basis. In terms of the hybrid issues, is a branch a hybrid entity? Well, potentially yes, because it will be taxed in two countries potentially, and the deductions that you get may be available in both countries. What you need to avoid is what is potentially a double deduction if there's no double income inclusion. So let's say I've got 100,000 of costs. Can I take that against the tax in the branch country and also where the main head office is? Well, potentially you could do that, but you have to have two lots of income. What you can't have is two deductions and only one corresponding form of income. And then branch employment tax issues. Maybe you're employed by the home UK entity. There's UK employment law, plus potentially foreign employment law, and you will need to think about setting up a payroll. Any questions on branches? So quite often you start off with the branch and then you end up with moving to a subsidiary. Now, a subsidiary is an independent plant. So what you can see there in the picture are little saplings. And they are therefore independent. And therefore there are different tax consequences in terms of their independence. But also what you're looking at there is in terms of that is that each sapling is independent, and what you may end up doing is incorporating a branch and turning it into a subsidiary. So incorporation of foreign trade, section 140 of the Taxation of Chargeable Gains Act 1992 applies where there is a permanent establishment abroad. Transferred to a non-UK resident company in exchange for shares or loan stock, giving the transfer at least 25% of the ordinary share capital of the transferee, including pre-existing holdings, and a net chargeable gain arises on the transfer. The net gain is rising is postponed until the security is acquired in exchange for the assets are disposed of, in addition to any gain that might arise on the securities themselves, but this might be exempted by the substantial shareholder exemption. If the transferee disposes of any of the relevant assets transferred to it within 6 years of the transfer, a gain is chargeable on the transferor. The appropriate proportion of the gain is deferred, which has not yet been charged, i.e. the gain deferred on the asset disposed of as a proportion of the total chargeable. Any questions? So a potential deferral of any chargeable gains within the group, but always watch for if you transfer assets at a gain within a group and that company leaves the group within 6 years, you may have a chargeable gain which becomes chargeable at that point, but you do have to look at the substantial shareholder exemption on that basis. In terms of establishing a subsidiary, you're going to look at a local law requirement, the incorporation of an existing branch, capital gains tax challenges, the use of losses, and the dividend exemption on that basis. The general approach, start of a business overseas, you would have a branch to utilize losses when established and profitable, and you would incorporate, therefore, into a subsidiary. So that would be the general approach that you would probably have. While loss-making, a branch, as it grows, incorporate into a subsidiary. Any questions on that point? Is this all making sense? Or is it the sun is up, the sky is blue, outside is beautiful? No? No reaction at all? Is this all making sense? A yes or a no might be quite nice. All good so far. Thank you very much. Right. All making sort of sense. All important. Great. Oh, questions and answers. No, it's just been on yes. So, some of us, that's unfair, Catherine, to be trapped in a windowless room. No sunshine for you. Oh dear. Is that in an office, Catherine, rather than at home? I assume so. No, that's a shame. Yeah. Well, you should be able to get out into the windows, out of the windowless room in a few minutes when we take a relatively short coffee break. Um, there is what we call a dividend exemption. What do we mean by that? That generally applies on dividends from subsidiaries to holding companies. Watch for withholding taxes. The UK does not, but other countries do, and you have to look at double tax treaties to see whether they are reduced for what is known as a participation exemption. Are dividends deductible in the local country? Fairly rarely. Normally, dividends are paid out of post-corporate tax profits. And are dividends paid from a country where the UK has a full double tax treaty? Hopefully, yes. In terms of dividend anti-avoidance rules, dividends out of profits pre-ownership, so where you've got a sort of dividend strip pre becoming ownership, dividends that are the economic equivalent of interest again, may be recognized as income. Dividends on quasi-preference shares deduction obtained in the local country, which means potentially it's taxable in the recipient country, and dividend paid under an arrangement to secure a tax advantage or transactions other than at arm's length, then you have to watch for anti-avoidance rules, which could bring those dividends into a tax charge. Are there any issues with the US if the LLC is set up there instead of a branch? Yes, there are issues. Definitely. You would have to look at the Anson case, Mr. Anson, who claimed a double tax credit. I think it's denoted under Swift, the Swift case, and eventually Supreme Court accepted or ruled in favor of the taxpayer, saying that the taxpayer could get a treaty relief for that. Since that, HMRC has published guidance which seems to partially ignore the answer to the Swift case. So there is still some doubt. If you go with the Supreme Court ruling, you should be able to get a tax credit in the UK for withholding and tax paid in the US. But the situation is not certain. And HMRC's recent guidance on this has made it less certain than you would like. This is rather like HMRC disagreeing with the referee's decision, even after 3 lots of VAR. I hope that answers the question. So after the coffee break, we'll take a 10-minute break. We will carry on with looking more at the individuals, which is about cost control, and then other elements on individual tax. So we'll take a 10-minute break now. It's 10 o'clock, so we'll be back at 10 past 10. Did anyone have any questions at this point before I carry on? Anyone have any questions? Okay, with no questions, let me carry on. Cost control. So looking at expenses, there are systems, different systems in different countries. Um, and um, so when I look at the different systems, I could be looking at per diems. So per diems are a daily rate. So it's from the Latin. It's a daily rate which is paid for spending time normally in a different country. There could be round sum allowances. Sometimes they are allowed. Again, it depends on the different country as to whether it's allowed. Reasonable expenses, which may need to be and would normally need to be receipted. So the UK goes down that route for a number of different areas, although they do allow round sum allowances with reference, for example, to the Foreign Office subsistence rates, which under the Freedom of Information Act have been published and are updated. And then you need to ensure that you're looking at the purpose of sorry, I need to shut the window because there is somebody gardening outside. One of those awful mow, blow, and go gardeners. You know, they make a lot of noise. They, cut everything in sight using the most noisy equipment, and then they go, and your garden is tidy for about 2 seconds. I don't use them, but some neighbors do. Important that you look at the purpose of the purpose of the expense. Was it for a purpose? So the UK uses the words wholly and exclusively for the purpose of the business. And of course, if it's an employment, it's wholly exclusively and necessarily in the performance of your duties, so therefore a stricter test. Every country has their own interpretation in that area, but generally speaking, business expenses need to be in respect of the business itself. Um, in terms of question, will you be looking at dual nationals operating in a third country? I'm sure I can probably discuss that, although it would be fair to say that dual nationals are generally, taxes not normally based on nationality. There are some examples, but where there are relevance, where it's relevant, particularly in Social Security, I will mention it. But obviously, in the course of a 3-hour talk, it's not possible to cover everything. But dual nationals, generally, nationality is not a very important determinant of tax. It is one of the final elements you look at where you're looking at where somebody's resident for tax treaty purposes, and it may be something that you might look at in terms of Social Security. So, you need to look at each system. So the German system, for example, tends to look at each country in terms of the city, in terms of the allowances that are given, whereas the UK says, sort of receipted expenses. So I could spend a night at the Peninsula Hotel if I was in London, cost about £1,000 a night. And if I'm there on business, then I could get my accommodation costs and my subsistence costs for it. So HMRC leaves it to the individual employer and company to work out what is reasonable. But if I go first class, for example, on travel or club class, I'm allowed that. There isn't something that says you're only allowed a deduction for, say, economy class. So it needs to be for the purpose of the business, and it needs to be something that the employer, well, generally speaking, it would be something that the employer has proved. Um, any questions on expense? As I say, in terms of per diems and allowances, they may be by reference to civil service rates. As I say, it could be a flat figure allowed by statute or concession. So the only the flat figures which are generally allowed are the personal incidental expenses, which is £5 per night when you're staying on business in the UK away from your place of work, and the £10 when it's overseas. And these rates have not been uprated since the 1980s, whereas the civil service rates do get uprated. And of course, that there are other rates in terms of meals, which can be either negotiated with HMRC, or you're looking at something like £25 for an overnight meal. So there are flat rates that can be given, but otherwise you are going to be looking at receipted expenses. Important that the purpose of expense, it may be a personal expense in terms of eating, but it needs to be incurred on company business. Receipted expenses, if like the UK, you need receipted expenses, that could be to give you a deduction, but also it may be a VAT receipt, for example. And one of the issues that sometimes comes up is the language in which it's in. But most VAT receipts will have VAT registration numbers and the ability to reclaim VAT, which may or may not be worthwhile, depending on the regime, something I'll come back to, and indeed depending on the amount of money involved. The purpose of the expense, you're going to look at things such as entertainment, marketing. So entertainment, normally disallowed in the UK if it's client entertaining, but do watch out in other countries. It may be allowed in other countries. Marketing, marketing is distinguished from entertaining, and therefore, if you have a client event where you are uh, uh, um, where you're promoting a new product, you may be allowed expenses that wouldn't be allowed under general entertainment. Always watch for whether it is client entertaining, which in the UK is disallowed for uh, corporation tax purposes. There was a time many, many years ago when it was allowed for entertaining overseas customers. And then, as sure as anything, everybody said that they were entertaining overseas customers. And therefore, the government decided, well, we're going to make it easier on ourselves. You won't get a deduction for entertaining overseas customers. Staff entertaining in the UK is deductible, but remember, could create a benefit in kind charge on the staff. There are some exemptions, such as the annual function. And even if the annual function is abroad or there is one for overseas staff, that could be allowed. But it's something that you need to think about very carefully on that basis, because otherwise it could result in a very high income tax charge. And distinguish that from subsistence, particularly when you're being sent abroad, where away from your normal place of work, where the subsistence would normally be allowed. In that context, so I need to open the window again. Gardner has disappeared, thankfully. In terms of subsistence, that could be covered by detached duty relief. So where you send someone abroad for a period not expected to exceed 24 months, there is the possibility that you will get detached duty relief, which means that reasonable subsistence, accommodation, and travel would all be deductible. It's a bit like staying in a hotel for a business trip that you wouldn't expect to have a benefit in kind charge on it unless you get lots of extras. So let's say you've got, sort of the meals would be fine, reasonable alcohol with the meal would be fine. But if you then go to the bar and order champagne, that would be personal. Similarly, you can get the accommodation, so the stay in the bedroom, reasonable meals, and so on. But you wouldn't be able to if you ordered a massage, for example, because there's a spa there, or you had a spa treatment, even if you argued that you need the spa treatment because you spend so long in front of computers, that would not be allowable and you need to distinguish it. When you think about detached duty relief, it's a bit like staying in a hotel for 24 months, or up to 24 months. You could potentially be allowed that deduction on that basis. Any questions on that? So in terms of elements you would look at sending staff overseas. What are we looking at there? Well, the challenges are obviously the tax rates, which could be different, the social security, equalization, and tax protection. Equalization. So, let me start at the beginning with tax rates. What am I looking at in terms of tax rates? Well, you go from a country like the UK to Denmark, for example. You go to Denmark, which is known as one of the happiest places in the world. So, not a bad place to go, but their tax rates are extremely high. Um, so, if you were telling me, Jeremy, the good news is that you're going to Denmark and you're going to have lots of hygge, that's good. But with a tax rate of 62% or so, not so good. And therefore, you might look at compensating me for the higher tax rates, and we'll look at that. Secondly, you look at Social Security, which in continental Europe, particularly with the recent reductions in the national insurance, we've seen a reduction from 13.25% to 8% for NICs. That reduction means that actually the UK's social security liabilities for individuals are considerably less than in most European countries. So therefore, you might consider whether you would be in the local system for social security, which is extraordinarily expensive in places like Belgium and France, rather than the UK one. You might be equalized, and equalization on that basis may be of some interest. What am I talking about in terms of equalization? Um, so what that says is that you don't pay any more or any less tax than if you'd left your home country. The point I would say about that, and this is where third country nationals come in, is where is your base? Where is your comparator? And one of the issues is that, you know, how long do you keep an equalization program going? How long is your home country the relevant element? So, once you've been in a country for, say, 5, 6, 7, 8, 9, 10 years, is equalization appropriate by reference to a country they haven't worked in or lived in for a good number of years? And then you get tax protection, and tax protection is even simpler, although potentially more costly. All you're doing there is that you end up with the downside being protected. In other words, if I go to a higher tax country, I end up with my employer paying me some money. Whereas if I go to a lower tax country, I keep the the windfall. And a lot of countries, if you went to Hong Kong, for example, Singapore, you'd pay up, or the UAE, you may end up paying a lot less tax. And the question is, who should get the benefit on that basis? Let's have a look at a few tax rates. Japan, Denmark, Sweden, sort of traditional high tax countries. Belgium, Israel at 50%, Netherlands 49.5%. Ireland is, surprisingly enough, people think of Ireland as a low tax country, is low tax for corporation tax, but not for income tax. Spain at 47%, Scotland also at 47%. And then you've got a bit of a grouping at 45%. So quite a lot of concertinaing there at around the 45% mark. And then you have lower rates in other countries, going down to Romania at 10%. There is no proposal gaining any sort of steam for a minimum personal tax rate, no equivalent of Pillar 2 for personal taxes. And the Biden administration has said absolutely not on that basis. Of course, other elements that you need to consider would be state rates. So in a federal system, you can't just consider the federal system, you have to consider the state rates. And for example, in the United States, New York and California have particularly high state rates of taxation. And when you add in New York, the federal, the city, the state, the city rates, you are talking about fairly high rates of taxation. Added to the fact that local property taxes in New York are hugely higher than UK council taxes. Thresholds. So, what would end up at the top rate of tax? The US has a particularly high threshold for that. Important to consider social security contributions, and this is where nationality may come in. You might want to maintain social security in the country in which you're going to retire to and hopefully draw your pension, and then find the incentives as well. Tax protection. Employer pays all extra taxes, and the employee gains if in a lower tax country. And you can see why in an environment of people trying to control the costs of their expat population. Tax protection, although is simple, is costly and has become less popular over the years. The other problem with tax protection is, let's say I went to Saudi Arabia, no tax, or the UAE, no income tax so far. How are you going to get me to move to a country with higher taxes if I've got used to paying very little or no tax at all? So therefore, tax protection can mean the employees choose to get stuck in lower tax countries and resist moving to higher tax countries, and therefore can reduce global mobility. Whereas tax equalization, employee pays tax as if she never left home, and hypo tax gets deducted. How would you treat employees that resident in the UK but sent to Germany for 2 months to build a rig? So the question would be, first of all, Katie, what I would look at would be so residences at UK but sent to Germany for 2 months to build a rig. So the first question would be, can I use Article 15.2b of the UK-German Tax Treaty in terms of they're going for 2 months, so that's less than 183 days. Are their costs being borne by the German entity or the UK entity? If by the UK entity, then potentially I could claim full treaty relief. Therefore, on that basis, I would therefore find that I would have no German tax and continue to pay UK tax on that basis under Article 15.2b. In terms of social security, under the Posted Workers Directive, I would apply to the UK for exemption from German social security, or continuing liability to UK social security, and therefore exemption from German social security under the EEA social security agreement, which the UK has continued to abide by. Hope that answers the question. So, yes. So generally speaking, on a short-term assignment, you'd use a combination of the treaties to keep them taxed in the country of the home residence. With tax equalization, as I said, the hypo tax would be equivalent to the tax they would have paid, hence hypothetical tax, if they'd not left the UK. And the hyper tax would be deducted, and therefore tax would be paid by the employer on the net amount. So in other words, if, say, I got £100,000 and maybe the hypo tax was £30,000, the employer pays me £70,000 and then pays if I go to Germany, the tax on the £70,000. And if it is more or less than the UK hypo tax, that is either a benefit or a disbenefit to the employer. And then you look at localization versus expat status. With localization, you have local conditions. Generally, you don't get extras and no tax guarantees. With an expat, you have home conditions with allowances and tax guarantees. So quite often this means that expats packages are particularly more expensive than local packages. And a lot of the discussion is about, after how many years do you localize expats? But there are other elements. There are allowances such as housing, cost of living allowance, tax prep fee. If you're a US citizen, you end up having a much more complex US federal return, state return, city return, and, for example, if you come to the UK return. So at that point, you and the employer will normally help with the fees. Relocation, education expenses, enrolling child in international school, for example. Home leave, quite often an extra package will allow home leave for the individual and the family a couple of times a year at least. And some places you go to a hardship allowance as well. In terms of the significant number of days that we look at, so are you looking at 1 day? 1 day creates a liability. Well, in theory, yes, but in practice, in most countries, that would not be the case. There is no set rule, but generally, under 30 days, you generally ignore and just keep them in the home system. After 30 days, you would monitor it. Then there's another sort of threshold at 60 days where there is compliance normally required. Then you end up with 182 days. So when you go over that, you're likely to be tax resident because that's more than half the year. And then 365 days, potentially spread over 2 years, could end up with tax residence over 2 years. Let's look at an attribution here. So Rolf, a Ruritanian national, spends 2 days working in the UK and 3 days in Ruritania per week for the same employer. Under the treaty, the UK will tax 40% of his earnings, assuming he does not qualify under Article 15(2) for a complete exemption, which he probably would. On the basis of 2 days a week, he's going to be there too long in the UK to qualify for the exemption. He will then either obtain either a credit for the taxes paid in the UK when filing his Ruritanian tax return, or potentially exemption with progression. In other words, the UK income will not be taxed in Ruritania, but would affect his Ruritanian marginal rate of tax. Let's assume Ruritania had joined the European Economic Area. What are the rules there? Well, if you work in another EEA country or Switzerland for an EEA or Swiss employer, this includes a UK employer, you are usually insured under the social security laws of the country you work in. You will not usually have to pay UK national insurance contributions. So how does that work for Rolf? Well, he has earnings. Remember, 2 days out of 5 in the UK, 40% subject to UK tax. If it is if Ruritania has an exemption with progression method, then 60% of his earnings would be subject to Ruritanian tax. But in terms of social security, we assume that he stays in the Ruritanian system, so 100% of his earnings would be subject to Ruritanian national insurance. Moving to Australia and continuing running UK business from there. What, the home in Australia? Would relocation still be available? My answer would be yes. It's not based on the nature of the duties in Australia. He's relocating there. He would still be able to claim relocation. Social security. So, as you may have noticed, life expectancy has gone up, pension costs have gone up, and therefore more countries are looking to tighten up their social security regimes. There is, for example, increasing cooperation with domestic healthcare, immigration and benefits agencies, prior notification registration schemes in countries like Belgium, Sweden, Estonia, and Germany. And social security has become more of a political issue. You will notice, obviously, in terms of, for example, the manifestos, although the Labour Party has just committed itself not to raise social security, the Conservatives have said that they would reduce employee another 2% by 2027 to 6%, and would abolish, if they could, over the lifetime of Parliament, Class 4, which is the self-employed national insurance impost. The interesting element is that other parties, so for example, the Reform Party, again, is trying to use Social Security as a means of implementing policies, and has proposed a super rate of 20% for employees employed from overseas in the UK, except in important or critical areas such as the health service and social care. Again, using NIC as a form of policy making, presumably to deter employers from taking employees from abroad. So you can see it's become more of an issue, and certainly something where people have different ideas in terms of Social Security of how it should be dealt with. In terms of the European Economic Area, what you look at is the country within the EU Social Security region, which includes Norway, Iceland, Liechtenstein, and the UK, which signed up to remaining within the system when it exited the EU. So we're looking at the EEA, which are the countries in green. We're looking at Switzerland, which is in purple, and the UK as being within the regime. In terms of Social Security compliance, does the individual have the correct type of certificate? Posted worker is someone who's posted for up to 2 years abroad. A multi-state is someone like Rolf who works in more than one state of the European Union. Assignment extensions, do the facts support an extension to the existing assignment from, say, 1 year to 2 years? Is the Social Security being paid in the correct location? With posted workers, their time limits for ongoing home country Social Security who are being seconded from from the UK to Belgium, you would certainly want to stay in the UK system because it's a lot cheaper. And therefore, you would have a 2-year element of posting. You would want an A1 keeping you in the UK system and outside the Belgian system. And the same is true for a lot of European countries. With a multi-state worker, where you're working in 2 or more EU member states, what you would be thinking about is, if I perform main duties in the country where I am habitually resident, then I could remain potentially for an indefinite period within the home country system. So let's say I spend 25% of my time working in the UK and 30% of my time in France and the rest of it in Germany, 45%. I could remain within the UK system, which would be a good idea. I could do it the other way around. A German national or German person who's habitually resident in Germany working in in France and, say, Spain, could remain within the German system on that basis. There is reciprocity. There are issues with this. Often there are application errors, applications submitted to the incorrect authority. Generally speaking, you submit the application to the authority where you are trying to remain subject to national insurance. And national insurance is generally in one country, not in 2, a bit like you only have one car insurance. On one car, you have only one life, unless you're Mr. Bond. James Bond, you only live twice, remember? But you only have one life, so you generally only have one national insurance number and, national insurance liability on that basis. Insufficient factors provided to the tax authorities to determine the country of habitual residence. And Social Security position assumed to be either where the employee resides or where the contract of employment is held. But you do need to consider the actual working pattern of what they're doing. And there has been increased focus by HMRC on the period of residence in the UK if it's less than the assignment period, the nationals of countries to which they are being posted. So if you post someone from the UK to France and they happen to be a French citizen, HMRC may ask more questions about why they're not in the French system. You make sure that you send the application to the right authority on that basis. And they are getting more picky about people on Social Security contributions and trying to, on a retrospective basis, regularize it. The other possibility is what is known as reciprocal agreement countries. So, outside the European Economic Area, UK has agreements with all sorts of countries, including the United States, probably the most important agreement given the flow of individuals between the two countries. Um, on this basis, what we're looking at there is a potentially a 5-year agreement with the United States. I could go over to the US and remain within the UK social security system for up to 5 years, whereas an American could come to the UK and remain within FICA for 5 years on that basis. So really, when you're looking at that, to ensure that um, you look at whether you can maintain home social security. Remember, you need 35 years of credits or contributions to the UK social security system to gain a full state pension. And then there are countries where we have no agreements at all. And the point about those countries are that there is a continuing obligation to UKNIC for the first 52 weeks of the assignment if the conditions are met. Those conditions are that the employer has a place of business in the UK, the employee is ordinarily resident in the UK, and immediately before the assignment, the employee was resident in the UK. So if you assign me from the UK to Singapore, where we have no agreement on social security agreement, we have a tax agreement, no social security agreement, I will be subject to UK social security and my employer will be subject to UK social security for the first 52 weeks of the assignment. As something that employers often forget. And it is a strict 52 weeks. Once you get to week 54, 53 or 54, you end up with no social security, and it's perfectly legitimate uh, to postpone bonuses. That won't save you income tax necessarily because bonus tax is on an earnings basis when we look at residency, but it is on an actual basis for national insurance. So postponing a bonus to say week 54 could save you a lot of national insurance liabilities. Where you go from a country like Singapore or Australia, where there's no social security agreement, to the UK, there is a reciprocal 52-week exemption from UK social security. So on the opposite basis, it may be quite a good idea to accelerate payments into that 52-week period where you have no UK social security. At the start of my career, I used to do lots of refund claims, particularly for Australians coming to the UK who would reclaim Social Security incurred in the first 52 weeks of their assignment in the UK. Then looking at business travellers, so where somebody travels a lot abroad, home and host liabilities to be considered. Generally, you have an ongoing home liability. Very few countries provide an exemption or de minimis number published, but I always think 30 days in a tax year or calendar year is about the rule of thumb. When do you need to obtain a certificate of coverage? There is, again, strictly speaking, no exemption from day one, but, is it regular business travel? Does the individual's role require them to work across 2 or more countries? Again, most countries are going to ignore the odd day or the odd week in their country. I think Brazil is the exception to that. But again, once you get beyond 30 days, you do need to think about this more carefully. And then practicalities, monitoring business travel. Monitoring where and when your expats or executives are providing, working overseas, and a trigger internal policy about when you should obtain a certificate of coverage. So where you've got the person working 60 days on a rig abroad, I would be looking for a certificate of coverage way over the 30 days. And VIP employees, obviously there is more sensitivity to compliance there. Any questions on that? Can the company claim business class flights as an expense for the director? Yes, if it is necessary for the duties. So, in other words, if the travel is necessary for the duties, you may have a different view about first class travel, whether it is necessary. But if the company pays for it, HMRC will deem that the company has decided it's necessary, and that is fully allowable on that basis. So hopefully that answers the question. Yes, it's allowed. Any other questions? No questions. Let me carry on to transfer pricing. So expanding overseas, if you have a number of entities within a group, then transfer pricing is going to become an issue. What are we looking at? Action profits are taxed where economic activities generating the profits are performed and where value is created, while at the same time giving business greater certainty by reducing disputes over the application of international rules and standardizing requirements. That is part of the BEPS comprehensive plan, and therefore, you look at transfer pricing. There have been increased documentation requirements, and actions 8, 9, and 10 are all about transfer pricing outcomes being in line with value creation. Where you actually creating value on that basis, where you're creating value, that is where you should be recognizing the income and therefore paying taxes. The areas which are particularly of concern would be where you have two parts of the group making cost contribution arrangements, looking at hard to value intangibles as well. So an intangible is inherently difficult to value, but more difficult than a tangible asset. The commodities which have considerable variation in their prices, and then risks and capital. You put capital in, how much risk are you taking? What reward should you expect? In terms of the UK regulatory framework, what you're looking at is that it needs to be interpreted again in line with OECD principles. It's very interesting, and I think it's a question of reverse psychology. The UK has always been fairly keen on adopting rules that the OECD has produced and their guidelines, and in most circumstances will adopt them. Whereas when we were part of the EU, we were very keen to find ways around them. And I think there's the difference between somebody suggesting you do something and you're happy to do it, and somebody deciding that you have to do something and forcing you to do something, in which case you find ways around it. And you would look at the transfer pricing guideline booklet. So this is the 660-page read on this latest edition, published January 2022. If you have trouble sleeping at night, this is a fantastic way of getting to sleep without having to take Mogadon or anything else. The regulatory framework, and the bit that is important, is if conditions are made or imposed between two enterprises in their commercial or financial relations, which differ from those that would be made between independent enterprises. So if I sell my goods from the UK too cheaply to my French sister company, then there is a transfer of value to the French sister company, and HMRC may say that actually there needs to be a transfer pricing adjustment. If there is a transfer pricing adjustment, then what you get, as I say, is where conditions are different conditions to the third party, you will get an adjustment of profits and a corresponding adjustment elsewhere. So let's say to an independent French enterprise, I sell goods for £1. Within the group, I sell them for 50p. HMRC says no. For tax purposes, you could recognize £1. What there should be is £1 is recognized in the UK, but as income, but £1 of cost should be recognized in France. So in other words, the treaty allows for an adjustment of profit, which would in this case increase the profit in the UK and decrease the profit in France. Any questions on that? In terms of the regulatory framework, we've got 9 chapters plus annexes. So that is 606 pages of this book. And it goes through all the principles of transfer pricing. And should you manage to get to the end of the book, you can certainly pat yourself on the back because A, you'll have become probably a transfer pricing expert, and B, you've managed to stay awake. There are other books on this basis. So you've got the UN Transfer Pricing Manual, regional bodies and guidance. So you've got the EU Joint Transfer Pricing Forum, which has sort of resuscitated itself and has become more active, and that involves relationships within the EU. There is the Pacific Association of Tax Authorities and the African Tax Administration. There's also this concept of safe harbors, that if you do things within certain parameters, you shouldn't be challenged. But there are also territories that don't use the arm's length principle. On that basis, one of the elements you might think about would be looking at the transfer pricing profiles. So individual country views that you can get on the website, which includes both the OECD countries and some non-OECD countries. Question: is there an exemption from transfer pricing for certain size companies in the UK? Yes, there is the good news is there is an exemption from transfer pricing for small and medium-sized enterprises. The bad news is that there isn't the same equivalent necessarily abroad. And also the UK has effectively brought transfer pricing to small and medium-sized companies by introducing very similar regulations, which are called profit fragmentation. They came in 2019 and deal with SMEs in a very similar manner to large companies in terms of transfer pricing. So always watch out for that. There is an analysis. There's a 9-step analysis, but it effectively boils down to 3 main components that build on each other. Transfer pricing, the functional analysis of who does what in which bit of the company, and the attribution of value on that basis. Then there is a comparability analysis, selection of method, which is the method of transfer pricing that you would use. And then there's the economic analysis of which sector are you sitting in within the economy and how should that affect your pricing and other economic policies on that basis. So you need that in terms of analysis. You are going to justify a transfer pricing arrangement. If you want to look at case law, I always think the DSG, Dixon's Group, versus CIR, very important UK case law. And here what you have is the Dixon's Group was effectively putting money via the Isle of Man. What was the money they're putting via the Isle of Man? You go to a shop, you would buy a washing machine or a TV or a laptop. You might well buy the warranty, and you might pay interest on goods that you buy on hire purchase. What Dixon's Group would do would recognize the profit made on the actual item, but the profit made on the insurance was reinsured via the Isle of Man, Dixon's International Services, Insurance Services Limited, an Isle of Man company. And what HMRC said, well, without the UK shop, you don't have an insurance business. And in any normal business, the insurance company would charge commission to the Isle of Man company. And that is exactly true. If they were independent, you wouldn't give away valuable insurance leads without a hefty commission. And therefore, HMRC won on that point. In terms of anything to do with knowing the practical steps in terms of this area, the important element is to know your company, know the sector you're in, apply the economic models, and only when you've done that do you apply tax law. And you need to think about, in terms of expanding overseas, involving structures. So the formation of a subsidiary. The headquarters takes the risk, the headquarters gives support, and the headquarters should take most of the, or a reasonable share of the profits. The subsidiary grows, the headquarters provides financial support, but generally speaking, you would expect the subsidiary to take more of the profits than before, and then the subsidiary matures, the subsidiary takes the risk, the subsidiary makes the profits, and although the headquarters would still get a share of the profits, it would be normally a reduced share based on the changing relationship between the head office and the subsidiary. So this is another answer, AJ, on this point. UK anti-profit fragmentation added to the current diverted profits tax rules and transfer pricing rules in the Armoury, and that complies with the base erosion profit shifting rules. And this is, if you like, transfer pricing for small and medium-sized companies, and the conditions, as you will see, are drawn very widely indeed. Here, there's a provision, effectively a transaction between a UK resident company and an offshore person. An offshore person is widely defined to include non-resident individuals and non-UK domiciled individuals and companies, partnerships and trusts established outside the UK. As a result of the provision, value is transferred from the resident party to the overseas party. This value must derive directly or indirectly from the profits of a business whose profits are chargeable to UK income tax or by diversion of income to an offshore entity or by payment of expenses of an offshore entity which are not commercially justifiable, because the value transferred is greater than it would have been between independent parties on an arm's length basis. What you've got here is a very wide element. If I own an entity overseas or have an interest and an entity in the UK, and there is a transfer of income between the UK to the overseas, either directly or indirectly, and I am seen potentially to reasonable to suppose that I enjoy that element. In other words, I can enjoy the profits from the overseas entity and get the tax benefit, then potentially that comes within the profit fragmentation rules. It is, the potential is to have an impact on small businesses as part of a wider clampdown on offshore tax avoidance, different from other measures because can apply to any size business, but also to unincorporated businesses and individuals. Can only apply if other anti-avoidance provisions are not applicable. So complex provisions and within self-assessment, looking at shifting profits to regime where tax paid is less than 80% of the rate that would apply to the UK. So on the 25% rate, that is where you've got, less than 20% CT, or 80% of 45% income tax, 36% income tax. As I say, it is very wide. It involves a transactional action of any type between an overseas person and a UK resident, leads to a transfer of value out of the UK, and a bit like famously in the Lady Diana, Princess of Wales interview, you need three parties to this: the resident party, the overseas party, and the individual element. The related individual. If I take it one example, and then we'll get our second tea break. Sea Limited is a UK resident company which trades as a management consultancy firm and has a 20% shareholder D. He is responsible for the company's overseas business and works from the UK, but he's the sole shareholder in a BVI, British Virgin Islands company, and agrees that overseas customers of Sea Limited should make payments to the BVI company. So C Limited is doing the work in the UK, and therefore it's UK source income, but the payments are made to a BVI company. And he's thinking, says, overseas customers, overseas company, what is the issue? But the point would be is the money should have been paid under normal commercial circumstances to C Limited. And on that basis, C Limited is the resident company, D is the related individual, and the BVI company is the overseas party. And what you can say is that there's an arrangement resulting in a transfer of value. Value can be traced through a number of entities, and they don't have to be companies, could be trusts, joint ventures, partnerships. A transaction otherwise than an arm's length, well, it's not a commercial transaction. Reasonable to suppose that the value transferred relates to assets to which an individual is entitled. An enjoyment condition or procurement condition is met, i.e. D, as the individual is going to benefit from this. Tax mismatch, so profits attract tax less than 80% of UK tax. And therefore, on that basis, if the main purpose was to obtain a tax advantage, you're going to end up, particularly in the BVI, you're going to end up with a diverted profits. Any questions on that basis? Okay, so let's take a 7-minute break now. I make it about 11:03. So at about 10 past 11, we will resume. I do have a question for you. You might want to think about that and then we might discuss. Okay, so a 7-minute break. Any questions anybody has? Okay, I mean, that would be, in terms of that sort of question, that's quite often happens with expansion overseas, that you end up with some sort of commercial deal that you need to think about in terms of the licensing and the know-how. How would you construct a commercial deal? And that may be used as a benchmark if you have other companies within the group. So in other words, you use the deal with the independent company to structure as a benchmark what you would do within the group. If I look at other knowledge transfer, if you set up new companies or branches or other elements in setting up a business overseas, you would look at the use of staff from the HQ, the trademarks and brands and the know-how. How are they being used and are they being properly accounted for? And that's always going to be important in terms of the allocation of income and the allocation of expenses. So I'm going to move on to indirect taxes. And here what I'm looking at, Q&A question. Will transfer pricing when companies are not connected but owned by the same individual? So you're definitely going to be within profit fragmentation on that basis, Michelle. Would transfer pricing when the company is not connected but owned by the same individual, would it apply? It could do, because there is obviously a relationship there. And if you're diverting profits, you could be looking at straightforward transfer pricing. But even if that did not apply, then profit fragmentation would apply on that basis if there are non-arm's and uncommercial elements to them, the transactions. Hope that answers the question, Michelle. So what's indirect taxes? What we're looking at there is GST, goods and services tax, VAT, value-added tax, sales taxes, customs duties and tariffs. The GST is a comprehensive indirect tax levied on the supply of goods and services in many countries. Comprehensive, there are often exemptions and exclusions and special regimes. A GST is a value-added tax applied to most goods and services sold for domestic consumption. Consumers pay the tax, but businesses selling the goods and services remit it to the government. Single rate in most countries with GST, a single unified rate, is applied throughout the nation. This simplifies the taxation system and reduces tax avoidance. Destination orientated, GST is destination orientated, which means that it is collected where the final consumer is located. In terms of adoption, France was the first country to adopt GST in 1954, so that's before the inception of the European Union. Since then, an estimated 140 countries have adopted this tax system in one form or another. Some of the countries with a GST include Canada, Vietnam, Australia, Singapore, UK, Spain, Nigeria, Brazil, and India. The UK adopted VAT on joining the European Economic Community, as it was then known, in 1973. And to the disappointment, but not surprise of many, it has continued with VAT even after we have left the European Union. VAT versus GST. Are VAT and GST the same, or value-added tax on and goods and services tax are similar taxes? They're levied on the sale of goods and services. Both VAT and GST are also indirect taxes, which mean that they're collected by businesses and then passed on to government as part of the price of the goods and or services. Key differences: VAT is primarily used in European countries and is collected at each stage of the production and distribution process. GST is used in countries around the world and is collected only at the final point of sale to the consumer. VAT is generally applied to a wider range of goods and services than GST. Rates of VAT and GST can vary depending on the type of goods or services being sold and the country in which they are sold. VAT is applied, as I said, to goods and services. There are different rates of VAT, compulsory registration for turnover over different levels, and a voluntary choice below this in some countries. In terms of VAT, what you have is input and output taxes. What is that? Well, if I pay VAT, so I charge VAT to my clients for the lecturing and other services that I do, but I also pay VAT on various elements such as laptops, electricity, hotel accommodation, and so on. So the input is what I pay, the output is what I charge, and assuming that I'm making money, because I don't do zero-rated goods, generally speaking, the output tax is going to be considerably higher than the input tax. And the difference between the two, let's say I have output taxes of 20,000 in a quarter and input taxes of, say, 5,000, then I have to pay £15,000 to HMRC each quarter. The idea is that it is tax neutral between vertical companies. What do I mean by that? So in other words, there is no advantage in there being a company, a multinational that does, sort of manufacturing, wholesaling and retailing, and therefore only has one VAT point, as opposed to an independent who may buy from a wholesaler who buys from a manufacturer. The idea of input and output VAT is that both of them should be on a similar basis. That otherwise, if you paid 20% on 20% on 20%, the more companies you have in the process, the more businesses, the more VAT they would be, and that would not be tax neutral. Any questions? Let's look at the EU aspects. As I indicated, in the EU, which is all the countries in green, and then you would add to that the countries of the European Economic Area, Iceland, Norway, and Liechtenstein. There are rules regarding this, and important to understand those rules, because what happens is that the EU sets principles, and out of those principles, member states will then implement the VAT. So there are differences. It's not although a VAT is on an EU directed basis, it's the general principles of VAT. The member states implement them. There were elements like the registration threshold for VAT is variable and could be anywhere between about £100,000 to zero. The UK has just raised its VAT registration to £90,000, which is probably higher than the EU would normally be happy with. EU VAT, but we're not part of the EU, so we have greater freedom in that respect. EU VAT principles imposed by directive, the member states implement, and their differences in rates, thresholds, and administration. In terms of this, there's a minimum standard rate in the EU of 15%, but reduced rate does apply for some goods. In terms of distance selling, currently, non-residents must immediately VAT register if supplying eligible goods or services in another EU state. The EU distance selling thresholds were withdrawn on the 1st of July 2021 as part of the EU VAT e-commerce package reform. However, there is a new regime, SME 2025 special regime, which introduces pan-EU 100,000 registration threshold to reduce the foreign VAT compliance burden. And the idea there is the EU member states have agreed to extend the same VAT registration thresholds enjoyed by domestic businesses to EU businesses from other member states. The aim is to encourage EU businesses to trade within the single market by cutting the costs and paperwork of VAT until their trade takes off. The new scheme is not, however, available to non-EU businesses. There will be two separate VAT thresholds. The €85,000 domestic threshold, the current regime, which member states may set up to a level of €85,000 per annum. Note that the UK one is higher than that figure now. And then there will be the cross-border threshold, €100,000 cross-border threshold, which business can opt to make exempt sales in other EU member states. This is up to €100,000 total sales and may be used in conjunction with the domestic threshold. One caveat is that the sales in any one state under the cross-border threshold may not exceed that country's domestic threshold. So it is possible that a country will set a lower threshold. If a business wishes to utilize the cross-border threshold, they must register to obtain a new X-prefix VAT identifier from the country of residence. The business will use this number to report quarterly to their home tax authority the VAT-exempt sale for the nominated EU state. Let's have a look at an example. Italy, for example, on this basis. So what we're looking at here is of Italy, who needs to register for IVA, which is the Italian VAT, what they call it there. Any business involved in the production, distribution, or provision of goods and services subject to IVA must register for IVA. This includes both domestic and foreign businesses operating in Italy. How to register? Businesses must register with the Agenzia delle Entrate, the Italian Revenue Agency. This involves completing the appropriate forms and providing necessary documentation. IVA principles, similar to elsewhere, Businesses add IVA to the price of goods and services sold. This is the output tax. Claiming IVA, businesses can claim a credit for the IVA paid on purchases relating to their business operations. The input tax. IVA returns. Businesses must file periodic IVA returns, usually quarterly or annually, detailing the IVA charged on sales and the IVA paid on purchases. The difference is either paid to or refunded by the tax authorities. Italian VAT. You see, I got caught on this because I bought a pair of shoes earlier this week. Yes, it was earlier this week. I bought a pair of shoes in Italy, and the shopkeeper didn't remember how the rules apply. And we started wanting my passport and all the details. Then we realized that the pair of shoes was only €70 rather than €175. So if you visit Italy and you purchase items for a value over €175 from a certain shop, you will be able to get a VAT refund once you come back to your country. You will need to save the receipt for the goods you bought, have your airplane or travel back tickets ready to show, carry the items with you without giving them to a third party, go to Italy's VAT refund station, mostly located in airports, tourist points, or travel hubs, and fill an official form out. And then you might get your 20% VAT back. Whether it's worth doing depends on the amount of money and your ability and wish to spend time doing these sorts of things. EU rules. General €175 is the minimum purchase amount to request a tax refund. It can vary according to the country you are bringing the items to. In many EU countries, this threshold is actually lower. If you do everything correctly, you'll receive a customs stamp for the items you purchased, and you'll get the money at the refund station via the cash and bank transfer. VAT rates in Europe, what you can see is that they are quite different. If you look at the Netherlands, 21.5%, potential. You've got reduced rates there. We've included Norway, which is in the EEA, but not in the EU, at 25%. The UK at 20% is now sort of slightly lower than others. And you'll see other countries like Finland, which theirs recently. So generally speaking, you're seeing quite high rates of VAT, and governments where they've had squeezes on public finances have looked to increase VAT. I would point out that both major political parties are not looking to increase VAT rates or expand the scope of VAT, apart from Labour, to private schools if they win the election. But if you look, VAT rates are quite high, the standard rates of VAT. There are also reduced rates allowed. Here are some examples of reduced rates. And what you can see there is all the rates are now generally at 20% or above. They are allowed one reduced rate, and some of them have also a parking rate and a super reduced rate as well. If you look at this, obviously Hungary at 27% is the outlier there, but Hungary has particularly low corporation tax rates, as I've showed. And generally speaking, you have seen rates go up, although there are reduced rates for different activities on that basis. And as you can see, these rates, there is some pressure for more harmonization on that basis. In terms of the notes, when one of the EU VAT directives was adopted in 1991, some EU countries were applying reduced rates, super reduced, or zero rates. Zero rates allow you to charge zero rate VAT, but reclaim all the input tax, which is like having your cake and eating it. Very appropriate, as cakes are zero rated in the UK. To ease the transition to a standard rate on these goods and services, a so-called parking rate was permitted. Although it was intended to be phased out, some countries still apply it. Since April 2022, to secure the principle of equal treatment, EU countries can apply two reduced rates, not lower than 5%, several goods and services, and one super reduced rate below 5%, and one exemption. So what you're seeing, and the timing is not perhaps surprising, the UK was very much against too much harmonisation of VAT. Once the UK had left, there's more harmonisation. High and low rates. Hungary at 27%, Croatia, Denmark, and Sweden at 25%. Luxembourg has the lowest standard rate at 17%, followed by Malta at 18%. Cyprus, Germany, and Romania at 19%. The average rate is 21.6%, more than 6% higher than the minimum standard VAT rate required by EU regulation. And there have been a number of changes. What you'll notice is that so Switzerland is not in the EU, nor is Turkey, but you notice that Estonia, Luxembourg, and Czech have well, Estonia and Luxembourg have increased their rates, as has Finland, and the Czech Republic has reduced the complexity of its VAT system by consolidating its reduced rates of 10 and 15% into one reduced rate of 12%. Among the 5 European OECD countries that are not part of the EU, Iceland, Norway, Switzerland, Turkey, and the UK, only Switzerland levies a standard rate below the EU minimum at a rate of 8.1%, which just means that if you're a Brit traveling to Switzerland, the actual restaurant bill is high, not necessarily extortionate. In comparison, in the US, the combined state and local sales tax rates averaged only 6.6% in 2023. If we look at sales taxes, which is what the US continues to have, 140 countries have GSTs, the UK included, GST or VAT. The US has the sales tax. And the sales tax is applied to retail sales of goods and services, and ideally should apply to all final consumption with few exceptions. Well, that is the theory. Many governments exempt goods like groceries based broadening, such as including groceries, could keep late rates lower. A sales tax should exempt business to business transactions, which when taxed cause tax pyramiding. So, an easy way to lose an election in the UK is to propose a sales tax on food. The last government that tried to do that was the Conservatives in 1906, and they won and they managed to lose by a landslide. And I think no serious political party is suggesting taxing food. So the VAT system only applies to around 55 to 60% of goods sold in the UK. But other countries do impose VAT on food. If you look at the effect of tax pyramiding under a gross receipts tax, what you end up with, it goes from the farm to the brewery to the distributor to the restaurant to the consumer. And what you would end up with is the ideal is just a sales tax on the final consumption. So when it's gone intra-business, no sales tax, at the end just with the consumer. The alternative on that basis would be that each element charges sales tax and the other side reclaims that, but that would then no longer be a sales tax. It would be more like VAT. However, with tax pyramiding, what you end up with is the farm charging the brewery, the distributor, the restaurant, and by the time you get to the consumer, the sales taxes are particularly high. Sales tax rates in the United States. In the US, retail sales taxes are a significant source of revenue at the state and local level. All US states, other than some relatively small ones, collect statewide sales taxes. Of these, Alaska allows localities to charge local sales taxes, but all US states other than Alaska, Delaware, Montana, New Hampshire, and Oregon do collect statewide sales taxes. As of 2024, local sales taxes were also collected in 38 states. And in some states, the local sales tax rates can rival or even exceed state rates. Remember, you have federal, local, state, local, and it's the state and the local areas that impose state rates. Sales tax rates. Obviously, you get countries, so the ones that are shaded, they all tend to be quite small. In New Hampshire on the right, Delaware on the right of your picture, and then you've got Montana and Oregon, and these are the ones that don't impose state sales taxes, but you can see most states do. You look at Texas, well known, and Florida, well known for having no income tax, but they do have sales taxes because they actually need to raise some money somehow. Obviously, in terms of this, sales tax rates can have a significant effect on consumer and business decisions. Sales tax avoidance is most likely to occur in areas with significant rate differences between jurisdictions. Research indicates that consumers can do and leave high tax areas to make purchases in low tax areas, such as from cities to suburbs. This is an example. Sometimes businesses locate just outside the borders of high sales tax jurisdiction. So a stark example of this occurs in New England, where even though the I-91 runs up the Vermont side of the Connecticut River, pictured on your right, rather a nice picture, I think, many more retail establishments choose to locate on the New Hampshire side, where there is no sales tax. And you will get the same with a lot of borders. So, for example, if I went on holiday a few years ago to Lake Maggiore, I stayed on the Swiss side. The little towns on the Swiss side had virtually no shops because all the shops on the Italian side were selling at much reduced prices by comparison. If you look at the UK system, we are unusual in having a lot of items with zero rating, where particularly food, but other items as well. And now we've left the European Union, there is constant pressure to extend zero rating on that basis, which means that you charge 0%, but you claim input tax back. If you have exempt, what exempt means is that you don't charge VAT, but you can't reclaim any VAT, which of course can mean that actually within the price, you have some irrecoverable VAT, which of course will affect your end prices. If you think about the schools, private schools at the moment charge fees without VAT, but obviously they do pay some VAT, and presumably under the new system, if Labour gets in, they will be able to reclaim the VAT that they pay. The unfortunate element for them, of course, is that obviously the vast majority of their costs are staff, on which there is no VAT, because salaries are outside the scope of VAT. Then there is the 5% on various elements, and then the standard element, which is 20%. And that's where you get all the interesting cases about marshmallows. So marshmallows are generally seen as confectionery and therefore at 20%. But a giant marshmallow, which is to be used on a barbecue, that is the primary purpose of it, will be 0 rated. You think of cakes, most cakes are 20%, are 0%. Most cakes are food, but most biscuits, particularly chocolate, have 20% VAT. You've got to draw the line somewhere, and there's lots of amusement about the line. Famously, is a Jaffa cake a cake or a biscuit? It was decided it was a cake, partly because if you put it in a biscuit tin with biscuits, the Jaffa cake goes hard and the biscuits go soft. And a Jaffa cake, described as a cake, has that element of rising and softness to it. Whereas Monster Munchies were definitely seen as, in a memorable ruling this year, Monster Munchies are seen as crisps, and the tribunal said you shouldn't be put off by the name. They are crisps. They should have 20% on them. And just because they're called monster munchies, they aren't actually munched by monsters on that basis. VAT process. So we've got a manufacturer pays for raw materials and services, charges for manufactured goods. The wholesaler, the output VAT of the manufacturer becomes the input VAT of the wholesaler plus other costs. So they're going to get that back. The wholesaler charges the retailer for goods plus output VAT. The charge by the wholesaler becomes the input tax plus other charges, which will then be reclaimed by the retailer, and then charges the customer output tax on the goods, and unless the customer is VAT registered and it's for a business purpose, you're not going to get that back. It's the customer that ultimately pays back at the end. In terms of the VAT cost for registered business, the cost is the difference between the input and output VAT. And hopefully, if they're making a profit, or that, generally speaking, they're going to be paying VAT because their output VAT will be bigger than their input VAT. One of the main exceptions to that is where they supply zero-rated goods, and that includes exports. With a non-VAT registered business or person, the cost is the total VAT charged to them by suppliers. When a company sells services to a Belgian company, would VAT be charged if business to business or business to consumer? So business to business is going to be zero rated, Shabir. Business to consumer, it depends, generally speaking, on the size of it. Normally, the consumer would have to pay Belgian VAT on receipt of the goods. So zero rated in the UK and maybe Belgian VAT at the end. Who accounts for it is a very complex area, depending on the type of business and also the size of it. So if he's doing services on that basis, it's providing services. Generally speaking, the services would be zero rated. The place of supply would be generally in the UK. But the Belgian company would probably have to organize reverse VAT to account for Belgian VAT on that basis. Voluntary registration. If most goods are supplied as zero rated, the customer can reclaim the VAT. And even if your turnover is below £90,000 per annum, you might consider doing that. And the same would be true with exports. What is not competitive is you wouldn't voluntarily register if customers cannot reclaim the VAT, or the customers have significant restrictions on reclaiming VAT because they're making exempt supplies. This particularly applies to banking and insurance. Indirect exports, supplier sells to the customer picks up the goods in the UK and is to export them. It's still zero rated, the customer is not UK based, but must have both official and commercial evidence the customer actually transported the goods to the intended country within the time limit. So back to my bird feeder example, where the Dutch customer picks up the goods, the UK company doesn't have to organise VAT, it'll be zero rated. As they contracted with a courier transport company, need to provide written evidence from that company. In the meantime, if they don't trust the company, then they might consider taking a 20% deposit on top of the invoice in case they do not provide the necessary information in time to cover the VAT that would otherwise become payable. If the customer is UK based, you cannot zero rate in this situation, even if the goods will end up being exported. You need to charge the 20%, and then the customer, when they export, will be able to charge zero rates overseas and reclaim that 20% as input. Imports of goods from outside the EU, the supplier never charges VAT On that basis, do you go through the red channel? The authority charged on the value of goods and authority charged duty on the value of goods and charged VAT on the value plus the duty. Normally, the VAT had to be paid before the goods are released, but could apply to defer it until following month, but still had to pay customs the amount due. This VAT is then reclaimed on the next VAT return as appropriate. So if I import goods or services from abroad, I end up having to pay VAT on the amount. Think of, if I bought a £1,000 spice box from abroad, I then go through the red channel, and then I would pay customs duty and then VAT on top on the valuable spice box. Import of goods, non-EU countries, purchase of goods from the EU are now imports rather than acquisitions. If the purchase of VAT registered, self-assess import VAT on box 1 of VAT return, claim it back as input in box 4 as appropriate. No separate payment of VAT to customs anymore. If the supplier charges VAT, either UK or foreign, challenge it, cannot recover VAT incorrectly charged. If the buyer is non-registered, VAT registered, 2 possibilities. Talks about goods valued at less than £135. Supplier must be VAT registered and charge customer domestic VAT. Goods valued greater than £135, customer pays VAT on importation to delivery agent, i.e. Royal Mail, DFP, FedEx, UPS. Sorry, goods less than 135, the supplier must be VAT registered and charge customer VAT. If the goods value is greater than 135, obvious element, the customer pays VAT on import to delivery agent. No duty should be paid on purchases from EU if goods originate in UK or EU, but paperwork has increased. Do not need a duty deferment account if no duty will arise, and Intrastat arrivals declarations not needed. Example, a German supplier sells goods to UK individuals, which it dispatches from its warehouse in Germany. What are the VAT implications for the supplier and customer if the goods have a VAT exclusive price of £120 a unit, £140 per unit? Analysis, the supplier needed to be registered with UK VAT for HMRC, does not benefit from the UK's registration threshold of 90,000, as is not established in the UK. It must charge customers 20%, £24, VAT on top of the price and pay this over to HMRC. It must file quarterly VAT returns with HMRC like a UK business. Under the second element, where it's a higher figure, the supplier does not need to register in the UK. The VAT liability is on the UK customer, who would owe HMRC 20% times £140, £28. In practice, the courier delivering the item would deal with the necessary import procedures and account for the VAT to HMRC, charging the customer for that. Here's another example. ABC Limited imported goods from China with 2 recent arrivals. Goods with a value of 400,000 and duty payable 32,000 on the 30th of December 2020, and goods with a value of 300,000 and duty payable of 24,000 on the 15th of January 2021. Calculate the amount of import VAT payable and how's this paid, assuming you have a duty deferment account. The analysis on there is VAT payable is 20% times 324,000, 64,800. The VAT company would report this as output VAT in box 1 of its VAT return that covers the import date, then claim the amount as input VAT on box 4. It can then claim all the input VAT back, so there's no net effect. The input and the output will be the same. Exporting goods to EU customers, the supply is 0 rated from a UK VAT perspective. At the moment, the customer deals with any input VAT. Distance selling rules do not apply. Full export declarations needed, plus licenses and permissions to avoid delays at borders. No EC sales list needed for UK businesses. and no intrastat dispatch declaration. The new EU system, if delivering to non-VAT registered customers in EU countries and consignment value is less than €150, must register with an EU tax authority for import one-stop shop. Declare all the sales of these goods in each quarter to each country and calculate the VAT due in each country. File with chosen authority and pay it the VAT owed. And normally you would, under the IOSS, you would do that with Ireland or Malta. Why? Because, of course, they speak English on that basis. Then you have the issue of what is known as triangulation, where you've got elements that go from an Italian company and sources the Polish goods from a Polish supplier. The Polish company sends the goods directly to the Italian company, and the Polish company invoices the UK company for the goods. So here I've got triangulation. That is not available now that we're outside the VAT rules. So here you can see order, goods, invoice, and then an invoice to the customer. Without triangulation, the UK company will have to register for VAT in Italy. By quoting this VAT number to the Polish supplier, the supplier to it will be zero rated. The UK company treats the transactions as an acquisition of goods in Italy, declaring output and input VAT on its Italian VAT returns and a separate domestic sale in Italy. In terms of this, so no triangulation. This is the procedure that you're going to have to go through. In terms of VAT treatment in other EU states where they are still within the EU, present the EU refund mechanism gives a right for a VAT registered business to claim a refund of VAT paid in the other EU member states, only where the VAT was incurred in the course of business, so hotel stays and travel. Also, normally transfers within members of a VAT group are where you're moving stock within a VAT group, they would be disregarded. There's also a margin scheme, interestingly enough, involving goods, for example, second-hand margin schemes, which will not usually apply for sales in Northern Ireland where the stock is purchased in Great Britain. VAT on these sales will be subject to the normal rules and must be accounted for on the full value of the supply. However, margin schemes will remain available for sales of goods that are purchased in Northern Ireland or the EU, whether sold to customers in Northern Ireland, Great Britain, or the EU. And margin schemes will remain available for sellers in Great Britain selling stock originally purchased in Northern Ireland or Great Britain. That's the margin scheme for second-hand goods. It is now quite difficult for UK companies to claim the VAT back for expenditure in an EU country which carries VAT on business. You have to use PDF forms and you need to decide whether the reclaim is worth the hassle and the money. In terms of cross-border supplies, where a UK VAT registered and the customer is UK, whether registered or not, you would fairly simply charge UK VAT if the place of supply is in the UK. UK VAT registered, EU VAT registered or customer in business, the place of supply is in the UK, you charge UK VAT. If the place of supply is customer state, customer accounts for any VAT, but the VAT would normally be zero rated on that basis. UK VAT registered EU non-business customer, if place of supply UK, charge UK VAT. If place of supply is customer's country, supplier must register there and supplier charge local VAT, generally quite often a nil turnover threshold. So when you make exports, you have to register for VAT. Where the supplier is foreign, to any UK VAT registered or business customer. The place of supply is UK customer accounts for the VAT. So that's reverse VAT, where the customer, rather than the supplier, applies VAT. And foreign, any country, UK non-business. If this place of supply is the UK, foreign supplier must register in the UK and charge UK VAT. And there is a nil turnover threshold, not 90,000. Reverse charge. So when I look at the reverse charge, what I'm looking at is where services supplied to businesses, customer, where the UK is the place of supply. UK customer receiving the service is deemed to immediately sell it. If VAT registered, must account for output VAT in box 1 of the return. Not VAT registered, deemed sale counts towards registration threshold. The UK customer is then deemed to reacquire the service in the UK, can claim the deduction for input VAT as appropriate. If the UK customer is 100% taxable, only makes taxable supplies at 0, 5 or 20%, this will leave it in the same position as acquiring a service from a UK supplier. You do not operate the reverse charge in the UK if the supply is exempt or 0 rated in the recipient member's state. Difference between business and non-business customers. Place of supply rules can depend on the nature of the customer. A VAT registered customer is always a business customer, even if the supply is received for non-business purposes. Customer in business but not VAT registered is also a business customer. Need evidence they're in business, i.e. letter from tax authority, letterhead, or other commercial documents. A non-business customer is one who's not of the above. In terms of the place of supply general rules, there are special rules for business customers. Services are treated as supplied where the customer belongs, usually the person with which the contract has been concluded, but not if it requires detailed discussion with another person as to what will be delivered. Non-business customers, services treated as supplied where the supplier belongs on that basis. And there's also special rules irrespective of the type of customer, which works in terms of land, sporting events, passenger transport, car rentals, restaurants and catering services, and hiring of goods, to basically ensure that VAT is paid on that basis. Special rules for business customers, electronically supplied services, supplied where effectively used and enjoyed, delivered by internet with minimal input, human input. On that basis, we look at, say, transport and ancillary services, repair services to an insurance company. If it takes place wholly outside the UK, treated as applied where it takes place. Let's take a final example on this basis, conscious of the time. Your firm currently prepares a UK self-assessment return for a French client who must report UK non-business income and gains. Prior to the 1st of January 2021, the supply was subject to UK VAT, as it did not fall within any special rule and the client is a non-business customer. Since January 2021, the supply is treated as taking place in France. No UK VAT will be charged. Under French EU VAT law, the place of supply will still be the UK as the customer is in an EU country, so the exception does not apply, and therefore no French VAT will be accounted for. In terms of supplies of services to EU customers for non-EU members, non-EU traders, that's us, in the UK, can either register in each EU country in which they supply services to non-business customers, or register with an EU tax authority to use IMOS, and probably Ireland or Malta, as their tax authorities' websites are in English. The new EU one-stop services from the 1st of July 2021, the EU introduced an import one-stop shop for distance selling. and a one-stop shop for suppliers who need to charge VAT on services where the place of supply is where their customer belongs, effectively extending the MOS concept to a wider number of supplies. Non-EU businesses could register for IOSS and OSS in an EU member state and account for their EU VAT liabilities using this service. However, finally, on this basis, VAT suffered in other EU states. So that's about selling in other EU states. What about my expenses? So prior to the 1st of January 2021, the EU refund mechanism gave a right for a VAT registered business to claim a refund of VAT paid in other EU member states. Only where the VAT was incurred in the course of business in, e.g. hotel stays, travel, was available through HMRC services. Since 2021, need to use the PDF system used by non-EU businesses, applied to each member state where the VAT was incurred separately in their language. The cost, of course, may outweigh the amount of VAT. And of course, it may take time, depending on the efficiency of the tax authority, to actually get the money back. So therefore, if you're in that position, that's just a cost of doing business in the other country. So at that point, thank you very much indeed. If you have any questions, there is my email address, although it is incredibly busy in front of the general election. But I will try and answer questions as and when I get the opportunity. I want to thank K3 for putting on this seminar, and thank you very much indeed. As I say, if you have any questions, that is the email address. Otherwise, I look forward to seeing you on a future occasion, and I hope you enjoy the lovely weather. Thank you very much indeed.